If you were to set up a business today, wouldn't you leverage off your existing business and try and raise debt against the business, or would you raise debt against your personal home?
Debts start to compound into your margins, and before you know it, you may not be able to pay the unsecured loan, personal loan, the car loan, because right now the ATO is the priority. There were 52,000 DPNs issued last year. That equates to about $4 billion in collectible debt for the ATO. So you really need to have an honest conversation. If your debts are over 150,000 with the ATO, director's penalty notices are being issued.
The word on the street, you hear it a lot, small business restructuring.
It's there to be able to support Australian businesses. Surprise, surprise. The ATO want businesses to survive. But the reality is that if there's a lack of communication, then they're going to have to start to enforce. Communicate with your accountant and start putting structures in place, because it's not a matter of if, it's a matter of when. The head in the sand mentality doesn't work anymore.
Hello and welcome to another episode of From Why to Wealth. I have with me today Peter Wyszenko from APICKLE. He's also known as Pickle Pete, just two bold men talking all things finance. And
There'll be a lot of that today.
So today, why are we here? So the word on the street is, you hear it a lot, SBR, which stands for Small Business Restructuring. And what we are going to do today is talk about the emotional factors that this can have on a business owner, but we'll also give a bit of clarity and insight in respect to decisions business owners can make to alleviate some of that business stress. And that's where you come into line. And I guess people do ask the question, if we're going through a small business restructuring process, can I still buy a property? The answer in essence is yes. And today's episode, we'll talk a little bit more around, if a director goes through a small business restructuring, can we still buy a property afterwards? Yes. And we're going to unpack it all today. Right? I think I just repeated myself, but doesn't matter.
No, it doesn't matter.
Great.
That's all right. No, you're happy. I'm used to that.
So business owners, some of them are also property investors, and then, who deal with brokers and so forth. In a quick overview, tell me a little bit about what an SBR, what it looks like and the process.
Well, an SBR, for clarity, it was brought in back in 21 by the federal government. It's essentially a COVID hangover. We remember, and we used to talk about it sort of back then, where a lot of these honeymoon rates, or honeymoons, I should say, especially with the ATO, was just essentially sort of forgotten about. I mean, there's a difference between a honeymoon and a write-off. A lot of directors thought, oh, they've just written it off. No, it's on a honeymoon. So as things start to compound, there needed to be an alternative to administration or liquidation or whatever the story may be. Because the ATO, surprise, surprise, want businesses to survive. And they want businesses to thrive, more importantly. But the reality is that if there's a lack of communication, then they're going to have to start to enforce. So if your audience get anything out of today, communication's the key. That's their KPI.
On that, communication is a breakdown of a lot of business relationships and personal relationships, and what I like to call the gap. And what you mean by the communication is the ATO wants to know, if you're going to struggle, tell us.
Correct. Yeah, absolutely.
Don't just let it slide one quarter into the next. And then when we effectively, make arrangements to reach out and call in our debt, it's like, oh no, what do I do? You would have known you've got this debt accumulating. So it's just a communication piece of...
It's hard to do because, when you've got a lot of things going on, and we all know that as business owners, there's a lot going on, especially in today's market. We've dealt with COVID. Now we've got inflation. There's a lot going on, and debts start to compound into your margins. And before you know it, you may not be able to pay the unsecured loan that you have. You may not be able to pay the personal loan, the car loans and everything else, because right now the ATO is the priority. So everything else gets forgotten about. So the purpose of the SBR, to answer the question, it's there to be able to support Australian businesses. The ATO component, a portion of that can be compromised, but you need to work with an insolvency practitioner. Behind an insolvency practitioner, the directors are still in control of the business, but you need to be able to participate in the SBR, meaning that your debts need to be under $1 million, your tax contributions need to be paid up to date. The problem that we solve is that when a business owner goes directly to an insolvency practitioner, the reality is that if there's outstanding super and tax contributions, then they can't participate. So it goes into an administration or a liquidation.
And I guess the SBR is
and that's the SBR, correct. And that's where we come in. So what we want to try and do is help those clients participate for an effective turnaround, which means we're going to pay out the first mortgage, we're going to pay out the second mortgage, we're going to debt negotiate with the caveators, we're going to pay out the outstanding super, then we're going to roll you into an SBR, so working with the qualified SBR practitioners that we work with. That in itself becomes an effective turnaround, because everyone talks about turnaround, but what is a turnaround? It needs to be an effective, holistic turnaround strategy. And that also includes commercial mortgage brokers. It includes the accountants. Every advisor needs to get involved to help turn Aussie businesses around.
Your broker with the right relationships makes that difference. So, Pete, you and I have known each other for a very long time. And every time we go on a new venture, we call on each other.
Of course.
Right. And we're like, hey, A, B, C, D.
Right.
And we're like E, F, G. And then we end up with an end solution of X, Y, Z. So why is your broker important? Pete would work with a lot of brokers. Is that correct?
Yeah. Majority of our, referrals, people that work with are coming from commercial brokers, insolvency practitioners, lenders, anyone that's got collectible debt. Commercial brokers are a great referral source for APICKLE, because when the LVRs don't work, our average LVR is 120% of the value of the asset. No one's going to fund that. So you need an informal negotiator to be able to make that work, and that's where we come into it.
So for the people out there who go, I've got a property worth $1 million, I owe $700 on the mortgage, I've got $300,000 worth of debt. How is it possible? It is possible. So we take the impossible and we just, we make it impossible. I know it sounds cheesy, but it's an actual fact.
Do you want a more cheesy now? We just get people out of a pickle. I'm going to throw that in, mate.
Where is my jar of pickles?
I knew that was coming. I'm going to take out for lunch. We'll get extra pickles. Don't worry.
But it's for your new to industry brokers. There is a solution. We're not ones to determine that. Hence why you're doing what you're doing. There is a solution. I plead, reach out to your broker. There is a solution out there. So great, from APICKLE comes in and he reaches out to the creditors to try and reduce those outstanding debts, which it'll enable them to complete the restructure, the small business restructuring.
Yeah, for clarity, we say creditors, but at the end of the day, we're talking about caveators, because what we need to do is rebalance the title. We want to be able to pay out the first mortgage, pay out the second mortgage, debt negotiate with the caveators, pay out the outstanding tax contributions. What we've done is rebalance the title. Okay. And that's really important to understand. Once we've rebalanced the title and those caveators have been removed from the title, there's no requisitions and claims and things like that's going to get made for that particular director. Then we can roll it over to an SBR, work with the insolvency practitioners that we work with. Their role now is to shore up the balance sheet, because the issue is, and what a lot of people don't understand, is that caveators can work both ways. They can either be in the administration, which is the SBR, or they can go for the asset. By us taking the caveators out, we've actually assisted the insolvency practitioners and we've made their life a lot easier. Now, all they have to do is effectively work with unsecured creditors that don't have PPSRs and all PAPs and all the rest of it, and work with the ATO. The ATO see that as a positive, so it's proactive, so therefore they will compromise a portion, not all, a portion of the debt. So now you've shored up the balance sheet, shored up the title, shored up the balance sheet. That's an effective turnaround. And that's how we can help more Aussie businesses survive.
Yeah, I always say it's not rocket science. However, in saying that, it's just that red tape. Like for a person, let's be frank, mum and dad business owners, what's their number one goal? To put food on the table.
Cash flow.
That allows you to put food on the table.
On the table.
Right?
Yeah.
You make $1, you can't spend $2. You make $2, you're meant to save $1. But people go, but I need the cash. So there is healthy debt and business overdrafts and so forth to assist with the cash flow in the business. But to get to a point of needing an SBR, which is a small business restructuring, you would have been in a position where you thought that caveat you took, or the second mortgage, that's how it usually starts, was the best option. And then you thought that caveat was the next best option. And then you forgot you signed the personal guarantee
with an unsecured lender.
For an unsecured lender, particularly around builders who sign personal guarantees for Bunnings, just throwing them into the mix, or some sort of trade supplier.
Or trade funding and things like that. So that's important.
And they forget about it.
They forget about it, yeah.
And they forget about it. And then long and behold, they come after them and they're like, oh, that's another one off.
Invoice financing and whatnot. So it all starts to compound. But we're not here to bash the lenders. They provide a very, very good solution for those types of businesses and those industries. So that's very important.
Just to clarify, at the point of approaching a lender and taking the second mortgage and that's what you believe was the best option at the time. And great, all is well at the time, but how you're trading your way out of that. Correct. And unfortunately,
you might lose a contract.
I was about to say the same thing.
And then before you know it, everything all starts to compound.
But how many of you out there have taken out a loan, let's call it a truck loan, because you had a contract 3 to 6 months into the contract, and then the person you had the contract with has gone, we don't want it anymore. We don't have the funds to pay.
Yeah.
I'm very sure you've seen that in your time.
Yeah, we do.
These are circumstances that are unfortunate and you can't help.
I just wish more people, and it's probably counterintuitive for our business, but we're here to provide, advice and support. I wish more businesses spoke to their accountant or their advisors, because if you've got a lot of compounding debt that's compounding into your margins, it's pretty easy for your accountant to work out your cash flow conversion cycle, for example, or, work out your working capital ratio.
Well,
because
you've got, I don't mean to cut you off there. You've got MYOB just top of my head.
Yeah, that's right. Zero, do it in 2 seconds. Just work out your balance sheet.
If you're looking at quarter in quarter, it actually works it out for you.
It works it out for you.
Mate, you're negative to last quarter. But again, you're running a business. I like to call it solopreneurs, whereby they're business owners by name. And no disrespect, right? No disrespect. It's difficult running a business. That
comes back down to what we're saying though, because if you're a solopreneur, you do what you do and you do that very, very well. But at the same time, who are the advisors that are out there that can help you? And so it's okay to reach out for help. And that's all that we're saying, whether it's an informal debt restructuring practitioner like ourselves, commercial broker like yourself, an accountant, whatever the story may be, they're out there to help. And it's very, very simple to work out your working capital ratio. Where are your assets? Where are your liabilities? What's the ratio? If it's under 1, you're trading insolvently. You've got to start thinking about, how can I get more cash into the business? Is it my receivables? Do I have to go harder with the, collecting funds, for example? Or do I need to start restructuring my debts? And is an SBR an opportunity?
It's not for everyone.
No, it's not.
It's not for everyone. So
you got to start somewhere.
Correct. Yeah. Absolutely. The question can be raised at no cost, and then you can base it off that. But look, so we've come to you. An SBR suits the individual circumstances. You clean it up, get the LVR within 70%, LVR being loan to value ratio. You've paid out everybody. Client's gone. Great. Sighs of breath of relief. Tell me what the next step is.
Well, at that stage, the businesses are generating organic cash flow.
Yep.
So that's a good thing. If there's still ATO debt, then there's a large portion of the balance sheet that needs to be attended to. So we've done the informal negotiation. We've band-aided it, so to speak. Now we've really got to really shore up that balance sheet for long-term survival and stability. So the SBR may be an option. But the thing is, with an SBR, it is a form of voluntary administration. So it is going to go onto your company credit report and things like that. There are other advisors that we work very closely with. A lot of tax advisors, for example, differ from a tax accountant, but they can focus on the interest and penalties and things like that and get that reduced. So that might also be an option, because there's certain businesses that we deal with, and we're talking about builders like in Brisbane. If they go into an SBR, they lose their builder's license. So they can't do that. So it doesn't suit every business. It's up to us collectively as a team. What is the best option for the business?
Where they would come into an SBR is if there's not enough equity in the property.
Well, I mean, from our perspective, we want a portion of the equity that we can use the debt negotiate with the KVTORs at a certain cents in a dollar. So we work out the debt and the cents ratio.
Correct. So let's just say worst case scenario, they're 120%. They own more than what the property's worth. That's where you come in and offer them a certain percentage in a dollar and work it from there. Let's say there's enough equity. They owe $500,000 against $1 million. Would there be a need to go into an SBR? I guess that's the question.
Well, I mean, I think, and that's good because we always sort of bounce ideas off one another. But if there's enough equity, then you guys as a commercial broker can consolidate that debt, and there's a lot of lenders that can assist you with that. It's when we're using a portion of the equity, but there's still outstanding caveators. That's when that portion needs to be debt negotiated to create a favorable loan to value ratio. So commercial broker can do a consolidation if the LVR is favorable. What about if it's unfavorable? That's where we need to step in.
What protections does it offer to directors? So so is it more or less the SBR says, hey, we're the director, we've claimed some sort of ownership in this, we want to clean it up. Once it's cleaned up, how is the director affected? What goes against their name?
Well, let's take a step back. I mean, during the SBR process, our insolvency practitioners that we work with will put the business into a 21-day moratorium period. So there's no requisitions or claims that can be made against the director during that period. So that allows the insolvency practitioner to put forward a plan to the creditors, and more than likely that will include the ATO. The ATO is a very sophisticated creditor, so you need to be able to get a sophisticated insolvency practitioner to work on your behalf. The benefit with the SBR is that the directors are working alongside the insolvency practitioner. So to the public, the director's still in control of the business, which is different from a VA, voluntary administration. You lose control of the business. Within that 21-day period, after that period, there's a 14-day plan that is obviously being issued to the creditors. And within that period, the creditors need to be able to respond within that 14 days. So that's really important, just to create the foundation for clarity of what the director is going through. When the plan has been approved, I should say, during that period, the director is now in control of the business.
Once the moratorium period plus the 14 days is done and dusted,
everything's accepted.
One would assume all accepted. For them, it's business as usual as long as they meet their commitments.
Yeah, correct. Because the insolvency practitioner is essentially guaranteed what's called a DOC, or the deed of company arrangement, over a 2 to 3 year period at a reduced rate. Because the insolvency practitioner, again, for clarity, he or she has worked out the cash flow conversion cycle of the business, and that works out essentially their debt in a sense ratio, so they can confidently make that offer to the creditors. The issue that I see with a lot of SBRs and VAs is that, again, it comes back down to what we're saying before. If there's caveators and large caveators that are within the DOCA, and you've also got the ATO, the likelihood of that plan being accepted may not be probable.
So you said 2 to 3 years with the DOCA. In the event that they've reduced the commitments and raised the equity to pay everyone, essentially, when I say it's business as usual, they've reduced it from $1,050,000 down to $800,000, being able to get the money, pay everyone, right? At that point, future lending isn't really a problem.
You would think so.
I was about to say that.
You're going into that.
You would think so. But that's not to say the creditor at such who lifted the caveat wouldn't go after the balance. Look, it's a bit different because I'd have to agree to accepting the X cents in the dollar.
Yeah, they've accepted it.
Correct. So from a director's perspective, he's done the right thing. He's sort of taken the one step away from having to negotiate with 1, 2, 3, depending on how many people that they have on. But essentially, you take over that burden from the director. It offers them clarity, as we said before.
Yeah.
And from an emotional perspective, there's somebody in there with him helping him to work this out. Is that essentially?
Yeah. Well, during that moratorium period, absolutely, because they're putting forward a plan to the creditors. Yeah, so that's really important. So they are certainly there to assist.
But again, if the creditors approve and it's final,
the director's then in control of the business.
Correct. What effect does it have on his credit file?
On the company credit score, an SBR, like on your Equifax or Creditor Watch and things like that, it does state external administration, which is a big concern for a lot of the lenders because obviously, as you know, it sits outside the lending parameters. There's not going to be a hope in hell they're going to get finance. The smart commercial brokers that are out there that we work with know how to read a company credit report. So you can see when the SBR started, who was the insolvency practitioner, what was issued to ASIC and whatnot, and they can see when it actually finished and expired and when the director then can regain control of the business.
It's about mitigating and putting a good
100%
story behind that.
And that's what you guys do best, right? So you've got to be able to think so. You like to think so, that's right. So you need to be able to create the foundations to put the client in the best possible position. So the good commercial brokers know how to read a credit report. And so therefore you can differentiate the difference between an SBR voluntary administration or external. So there's only one classification of the SBR, which is unfortunate. I do believe a lot of the credit scoring companies out there will start to change that, but that's going to happen in time. Right now, it's going to stay external admin. We need to be smart enough to be able to differentiate what that actually is by reading the report. Now, from my perspective, with a lot of the lenders that we do work with and that are doing the commercial debt recycling and the home loan in which we do, we've debt negotiate everything we just spoke about. At that point, the company credit score has organically increased over a certain period of time. Could be 8, 12, it could be 14 months.
I've always mentioned that the effects on the inquiries do affect your credit score, but the less inquiries you make in that company, for example, in this instance, cleans up that credit score.
100%.
Yeah.
But see, the thing is that why aren't the commercial brokers that are out there, the really good ones are doing it, but the ones that are not reading the balance sheet, or they're not speaking to the insolvency practitioners and go, can you give me the report? Can you give me the insolvency practitioner's report? And they're more than happy to give it to you, because with certain conditions, of course, but if you have a very clear understanding of what's in that report, you're going to get an understanding of what the ATO compromise, for example, or you get the ICA, for example. Ask for the ATO portal. You can see that a portion have been compromised. So the reality is that you can then determine how strong the balance sheet is. And so why wouldn't a lender take it? If I was a lender, it'd be great. They've reduced the debts. Happy days.
Yeah, but it's not only reduced the debt. If you've gone into it for a short period of time and you've come out, one would assume that you wouldn't be punished forever.
No, because you've done the right thing.
If the question's raised, for all the ones that do have this scenario and go to your brokers, take the insolvency report. Just provide it. Hey, this is the situation that happened. For any good brokers that have to mitigate a loan when you put it through, you just wouldn't send it to a major bank because they'd probably knock it on its head, right? Are there options out there? Yes. And at that point, when the questions are raised, or you do go into an SBR and it's put on your company credit, you would want the insolvency report because that's going to help you with less questions asked.
Correct.
And that's what it is, right? It's about educating people to get a better understanding and get a stranglehold of what brokers / lenders are looking for.
There are a lot of lenders out there at the moment that understand the process. There's more and more lenders that are taking on businesses that have gone through that process. It's up to us collectively to work holistically with the directors and, more importantly, with the advisors, so the clients, the directors, can purchase a property shortly thereafter. Let's take the other end. If we're involved at the beginning and a commercial broker has referred it to us, we've then restructured, we've paid everybody out, we've reduced the caveators on the title, and they may be with us within our commercial debt recycling home loan for a period of 8 to 12 months, if not longer. We're then going to have to refinance that client at some stage. We don't do refinancing. We're going to give it back to the commercial broker that referred it to us. And we're going to provide all of the information that the commercial broker requires.
And they would have been part of.
They're already part of.
They would have been part of. You mentioned that if we just go back a few steps, you mentioned, I actually had in my head, I didn't say it. I always look around.
That's unlike you.
An SBR. You wouldn't have that conversation around a barbecue. You wouldn't show up to a barbecue and go, I'm in a lot of debt. A lot of people hide it, and that's where the emotional factor comes in.
Like, just to touch on that, when it comes to debt, there's fast growth equals fast debt, and you're going to have to take on a lot of debt to be able to grow that business. At some stage, you need to restructure it, mate. Like, you need to restructure that debt at some stage, because you started the business on an oily rag and you took on whatever debt that you could. I mean, when you and I first started businesses,
we didn't have the bank of mum and dad.
There was no bank. There was no bank of mum and dad.
There was that bank of
mum and dad. You know,
it was Bank of Energy.
Bank of Energy. That's right. That's right.
But that's what it was.
It was credit cards. That's all there was. Like, you clock up as many credit cards as you could. So today's reality is no different. It may not be a credit card. It could be, an unsecured lender, but an unsecured lender provides a really, really good, valuable resource at that period to be able to get a higher amount. And I know you're going to touch on it, but if you've got unsecured loans versus credit card debt, to me, that's favorable. But the key is that what is the exit strategy? How are you going to pay back that unsecured loan in a certain period or within the terms?
You buy a car today, you're going to take a 60-month term. What's the goal to do at the end of the 60 months?
That's right.
With the debt? What's your goal?
Yeah, own it, pay it out.
We don't look at debt like that with everything else. Oh, they gave me a 5-year personal loan or a company loan. I have to pay it. But if I gave you $10,000, I apologize. If you borrow $10,000 out of your company, you got 7 years to pay it back. You're not really fussed with paying it back sooner, right? So I guess it leads me to the point where I get some people, I want to grow my business. Oh, I've put a lot of cash into the business. And I go, okay, we'll get a business loan unsecured. It's about hypothetically 8, 9, 10, 11%.
Better than what we had to do back in the day with a credit card.
Why would I do that? The interest rate's high. Okay, but you're just telling me cash flow's taking a hit. Oh, credit card, you understand, but the credit card's at 19%. Right. And you can't write it off on business. Because the majority of the credit cards you get are in your personal name.
It's in your personal name. Right. So why wouldn't you get an unsecured loan? It's under your company name.
Go get an overdraft. It's tax deductible.
That's right.
And it's healthy debt.
It's healthy debt.
No, I'll go get a credit card. Okay, no worries.
Yeah. So, and that's the key to all of this. It's understanding it and having the right advisors to guide you through that process.
So I guess in a nutshell, and on those, and I guess we don't have to talk in points and so forth. It does go on the credit file with the right questions being raised by your broker. We're telling you guys, take your insolvency report with you. Everything that you need is there, right? It is there may, at the point of it finishing. What I mean by it finishing, I mean the date ends. The SBR finishing, the date ends. It shows it on the credit report, correct. It means that you just then need to treat it same way as it would, I know it sounds bad, as a bankruptcy or a liquidation. It comes out at one time and there are lenders that can help with that.
That means that the balance sheet now has been shored up. So they're actually in a stronger position now than what they were when they first started. So that's a good thing. But the lending parameters, what's your opinion on that? I mean, you guys deal with that more than what we do, but
I'm very
third tier. I mean, that's
No.
Yeah.
You could possibly go to a second tier lender.
Yeah. Okay.
Options.
Yeah.
I talk about it all the time. I know it sounds silly in rugby league, right? You always have inside runners, outside runners.
You're a dummy half.
5'8".
Okay.
Half.
Yeah. Okay. Half there.
But why do you have inside runners and outside? Because of my height, yeah. That's why you thought inside runners, and it's been quite a few years since I've stopped playing, but why do you have inside runners and outside runners when you're in attack? It's for options.
Yeah, 100%.
Right? Silly analogy, I don't care. It's my analogy.
It works,
you don't like it, it's your bad luck.
Yeah,
but options, it's the same with private lenders. Look, you'd only go to them if there was no other options, but there are second tier lenders who... an example, if you've got one day discharge bankrupt, that could help you. Rates are not the greatest, but there are options out there. So I talk about it all the time, same as what I did in rugby league analogy, options.
Well, I know from our perspective, like the private lenders that we have on our panel, where we've got to be able to facilitate and aggregate a creditworthy borrower, because we're proving to the private lenders that this director will be creditworthy at a certain stage.
No different to a commercial broker.
It's no different.
No different.
The reality is that there's a whole heap of KVTORs and we're being transparent. This is where it's going to end up at. So therefore it will be at 70-75% depending on location. So that's where a lot of our technology
if
comes
anything,
into it.
Your job's harder than ours.
100%, because there's a debt and a sense ratio that we've got to portray to the KVTORs to create a creditworthy borrower.
You've got $1 and the debt's $2, you've got to make it work.
Got to make it one.
And in the environment that we're in, and I was only talking to a plumber the other day who lost $30,000 from a job, and he was one of the creditors, and he'll end up with squat diddly nothing, and that's an impact on a small business, right? So I guess, again, we've touched on this, mistakes to avoid after SBR, or even to get to the SBR.
Well, no, we had these notes and we just started gibbering like we always do, mate.
Well, so we touched on a lot of it, but mistakes to avoid after SBR. We just said that sometimes you can't help it. Sometimes you've bought a truck to help with a contract, and then long and behold, 3 to 6 months of great work, the contract just gets pulled from underneath you, and just it's a roll-on effect, right? So I will stress this: some form of business debt is healthy debt. I don't believe it's a bad thing. To take money out of your personal home to invest in the business.
Yeah.
So I don't.
I think the problem that I have with that analogy, and I'll just take the opposite end of that argument, when company debts have been effectively aggregated into a personal debt.
Pause. We're looking at ways to avoid after an SBR. I've sort of done two steps back and gone, if you were to set up a business today, right, and you've got a current business, wouldn't you leverage off your existing business and try and raise debt against the business, or would you raise debt against your personal home? That was the question. So yes, when you start the SBR process, yes, the home, I understand that. Yeah. I'm talking about prior. So I've gone back 2 steps.
Okay.
Wasn't in writing, sorry.
Yeah, no. Well,
sorry,
we haven't read anything in writing.
We've touched on it. We've touched on it. So
yeah.
The topic, the next question was mistakes to avoid after SBR. I'm talking about the mistakes to avoid prior to even contemplating when you're in business. And would you?
Well, during that business period, I mean, and we alluded to it previously, that you're going to take out a loan. It could be a commercial loan against the business. You've signed a personal guarantee. And then you've now dishonoured and defaulted. So it becomes commingled with your personal asset. So at some stage, you need to debt recycle that debt because the company debts have now become personal debts. So there is another end of that argument, which is what I'll touch.
So mistakes to avoid after SBR. And one of the things was how should they approach future borrowing differently?
Well, it really you've got to take into consideration what has the informal practitioners, someone like APICKLE, and also the formal restructuring practitioners, what have they done to clean up the title and to clean up your balance sheet? That is the key for future financial stability and also future growth, whether it's an individual, whether you're purchasing, a property with your significant other. It needs to be done properly, because if it's not done properly, the alternative is a voluntary administration or even worse, a liquidation. And that's bankruptcy trustees and things like that. No one gets anything, and we're trying to avoid all of that. That's right. And that's what you don't want. So it needs to be done properly.
So I guess to wrap up, APICKLE comes in. They have the right advisors around them. They're referred by a broker. If the client says it's out of my accountants, which I hear 1 out of every 10, my accountant's got no idea. So that's when the accountants, brokers, debt negotiators all work in tandem to get the best solution possible, which in some instances may be an SBR.
Maybe, yeah.
Not for all.
No, God no.
And then you find that solution. So you wrap it all up 8 to 12 months later, client is at their free will to go off and do, or it could be sooner.
You want to start with informal negotiation first. That creates the foundations. You then want to roll into formal negotiation, which is what we touched on. After that, the third step is a refinance. And so what you're doing is that you're obviously starting off at a higher rate because there's a risk factor and things like that. The risk factor rates for a commercial debt recycling home loan is going to be, 9.5, 9.85, could be a line fee, things like that. Depends on location and whatnot. But it's far exceeds what you currently have with multiple KV-TORs registered against your title. That's how you generate organic cash flow.
Yeah.
Correct. And so if you're generating organic cash flow, that means that you're reinvesting back into your business and or you're accelerating the repayments of your home loan. That's going to put you in a better position. So we're going to monitor all of that during that period. And so in the next 8, 12, 18 months, it gets bounced back to the commercial broker. Then we can then focus on the third step, which is the refinance. So you're going to go from 9.85%. You can answer this, back to the non-banks, 7.5-ish?
It's hard to say because it's tiered on certain borrowing, 70, 75, 80. If it can go to that high, at what point can we go to that? But it is something that can be considered.
I suppose what we're trying to point out is that it's going to be a staggered approach from slightly higher to a refinance. We've got to be able to get those directors to that stage, and that's the important key out of all of this.
In conclusion, what's your final thoughts? Where do you think business owners are heading? What are you seeing?
We're seeing a lot of directors' penalty notices being issued, and that's probably a topic for another day. We won't touch on that now. But there were 52,000 DPNs issued last year. That equates to about $4 billion in collectible debt for the ATO.
Hence why they're going.
Outstanding debt is around 60-ish billion. That's outstanding. So they're going to be more aggressive this year moving forward. So you really need to have an honest conversation. If your debts are over 150,000 with the ATO, directors' penalty notices are being issued. if you're not communicating, which we're now going to revert back to what we said right at the beginning to be able to wrap this up, come back down to the communication. Communicate with your accountant and start putting structures in place, because it's not a matter of if, it's a matter of when. And so if you get issued with a director's penalty notice, and let's say it's a lockdown DPN, you've got 21 days to be able to pay that in full, or otherwise you're personally liable. So the head in the sand mentality doesn't work anymore. You know, it used to be back in the day, you could ring up the ATO, get a payment plan, no problem. That doesn't happen anymore. You still get a payment plan, obviously, and that's important. But
more questions asked.
It's at what stage are they going to enforce it, and they're enforcing more aggressively. So we see a lot of debts compounding. We see, you know, inflation obviously plays a factor. If you've got a payment plan, you've got another BAS, you know, again, that's compounding. So you need to have those honest conversations.
Pickle Pete, thank you. And until next time, stay safe.
Appreciate it, mate. Thanks for the invite.
Thanks, buddy. Cheers. Thank you for tuning in. You can follow us on TikTok, Instagram, Facebook, YouTube, LinkedIn, and all major streaming platforms such as Spotify and Apple Music. Links are in the bio. Everything mentioned on the podcast is general information only and not to be taken as financial, tax, or legal advice. Always consult a professional, as everyone's individual circumstances are different.